Welcome back to the Deep Dive. Our mission today, well, it's pretty clear. We are charting the immediate future of institutional crypto adoption.
Exactly. We're moving beyond the usual suspects, Bitcoin and Ethereum.
Right, we're zooming past that established territory to focus squarely on the altcoin frontier.
Yeah, the next wave.
Specifically, we're diving deep into the regulatory status around altcoin exchange-traded funds, the assets really under the microscope today. Litecoin, LTC, and Hedera, HBAR.
In our source material, it paints a really vivid picture, doesn't it? It's a market moment defined by, let's say, extreme tension.
It really is. On one side, you've got these key ETF proposals, basically at the goal line for final SEC approval, definitively there.
And it's a big but.
A massive politically manufactured but. The ongoing U.S. government shutdown is threatening to put this whole historic expansion on ice, maybe indefinitely.
That dual narrative is absolutely the core tension defining the market structure right now. You know, we have the foundational work done, the tech, the legal arguments for legitimizing these altcoins for mainstream finance. It's nearly complete.
Seems like it's all ready to go.
But that final procedural hurdle, it's currently impassable. Why? Because the gears of the regulatory machine, well, they've literally ground to a halt because of Washington politics.
And why is this deep dive so critical for you, the listener, the informed learner? Because this transition, moving from just Bitcoin and Ethereum into a diverse range of altcoins, this represents the true second wave of institutional crypto adoption.
It really does.
We are dissecting the exact mechanisms, the how, by which traditional capital, think pension funds, large asset managers, those established Wall Street brokers, is preparing to inject potentially trillions into these broader altcoin ecosystems.
Understanding this whole process and, crucially, how political gridlock messes with the timelines, it's your shortcut, really, to staying several steps ahead.
Okay, let's unpack this. So let's start with the regulatory reality, which, despite the politics, seems overwhelmingly positive on the merits. The analyst consensus is that multiple crypto ETF proposals are essentially ready for immediate execution.
That's the word on the street, yeah.
So when analysts talk about proposals specifically citing Litecoin and Hedera, and they use that phrase at the goal line, what exactly does that signal in regulatory terms?
Well, at the goal line is pretty specific language in this context. It means the really critical, complex work proving the underlying asset is actually suitable for a regulated product that work's already been done.
So the hard part's over.
Pretty much. The SEC staff has likely finished their deep analysis, digging into custody, valuation, market manipulation concerns. And the sponsor, the company proposing the ETF, they've successfully addressed the SEC's comments on all those points.
Okay.
So what's left is basically procedural sign-off, or maybe just the final administrative clock running out. They aren't fighting some fundamental legal battle anymore. They're just waiting for a signature, essentially.
It sounds like these analysts aren't just, throwing darts. They're reacting to maybe internal conversations or just the maturity of the applications themselves.
I think that's fair to say. These applications have gone through multiple rounds of feedback.
Right. But let's talk significance. We've seen Bitcoin ETFs. We've seen Ethereum futures ETFs. Why is a Litecoin or an HBAR ETF such a historic leap? Why is moving past the dominance of just those two initial titans such a big deal?
Because it's the formal declaration that Wall Street is moving decisively into multi-asset adoption. It's huge.
Multi-asset, meaning not just Bitcoin.
Exactly. For over a decade, the institutional crypto narrative was really restricted. It was Bitcoin, the store of value, and then more recently, Ethereum, the smart contract platform. That was kind of it.
The big two.
Right. Now, accepting LTC and HBAR, it signals that traditional institutions view crypto as a diversified functional asset class. That value exists across different utility layers, different technologies, and that's absolutely critical for portfolio theory, for diversification.
So it's the ultimate legitimization, isn't it? Particularly for these specific assets. An ETF vehicle makes these coins immediately accessible to pools of capital that, just by their own rules, by mandate, they cannot directly hold volatile, non-custodied digital assets.
Precisely. You're talking about risk-averse pension funds managing billions, maybe trillions, massive university endowments, those traditional brokerage clients who rely on their advisors.
Yeah, the really big money.
And that approval, it's far more than just a price catalyst, though it certainly is that. It's a stamp of regulatory permission. It changes the whole narrative around the asset.
How so?
It shifts the discussion for asset managers. It goes from, should we risk holding this, speculative digital thing, to the much simpler question, how do we efficiently allocate a percentage of our portfolio to this newly validated vehicle? Once the ETF exists, the asset is basically plugged into the traditional financial plumbing.
Okay, that makes sense. And to address that core tension we kicked off with, this readiness brings up the pivotal question we keep hearing from our listeners, from you out there. Are we actually witnessing the genuine start of the altcoin ETF era, an era underpinned by regulatory readiness?
Sure.
Or is this just destined to be another false start, completely derailed by political gridlock?
That is the central focus, isn't it? The technical readiness, the regulatory groundwork, it all looks robust. It's there. But, in an environment where the administrative bodies, the agencies are hobbled, well, technical readiness means absolutely nothing if those final administrative steps just cannot be taken.
The market's just waiting.
Holding its breath, waiting for Washington to decide when the business of financial evolution can actually resume. Before we dig deeper into Litecoin and Hedera and their specific challenges, maybe we should just clearly define the function of these exchange-traded funds in this context.
Good idea. Because an ETF tracking a crypto asset, it's not the asset itself, right?
Exactly. It's a security, it represents ownership in a fund, and that fund holds the underlying crypto asset. And crucially, it trades on regulated stock exchanges, like the NYSE or the NASDAQ.
And the genius of the ETF structure, especially for crypto, is how elegantly it solves those three major hurdles for traditional finance. First, custody. Big one.
Huge. Institutional investors do not want the liability of holding private keys. It's complicated, it's risky. With an ETF, the manager handles all of that.
Problem solved. Second, compliance.
Yep. ETFs are regulated investment vehicles. They satisfy all those internal risk mandates and compliance checks that big institutions have.
Checkbox ticked. And third, access.
Access is key. Traditional financial advisors, the ones managing most people's money, they can now seamlessly place crypto exposure into their client portfolios using a familiar product.
So it really is the necessary bridge. Connects the sometimes chaotic, fast-moving world of crypto with the, let's say, compliance-heavy, rigid infrastructure of institutional finance.
That's a perfect way to put it. And we saw the seismic impact of this exact mechanism when the Bitcoin ETFs launched. And even with the Ethereum futures ETFs before that.
They weren't just a win where they were like the proof of concept.
Absolutely. Proof that massive institutional capital could safely enter the crypto space using this vehicle. So now, this pursuit of LTC and HBAR ETFs, it represents the next logical phase, diversified crypto portfolios.
Institutions aren't just looking for one store of value anymore.
No, they're looking for functional assets. Assets with different risk profiles, different utility cases. They want a menu, not just one dish.
And this movement, it's already influencing what people expect next, right? Analysts aren't stopping at just LTC and HBAR.
Not at all. They're already building a watch list, you could say, of other established projects that have the right kind of regulatory profile, the market cap, the history, to potentially follow this same path.
And we hear names like Chainlink often cited.
Yep, Chainlink with its essential Oracle utility.
Solana for its speed.
Solana, high throughput, yeah. And Cardano.
Cardano with its very rigorous, research-driven development approach.
Exactly. The precedent being set right now by Litecoin and Hedera, it's basically paving the way for a whole ecosystem to potentially follow suit, assuming they meet the criteria.
So we connect this to the bigger picture.
Yeah, connecting the dots. The approval of these two very distinct assets, you've got a legacy payment network in LTC, and this cutting-edge, enterprise-grade platform in HBAR, it essentially creates a standardized regulatory pathway.
A pathway
For pretty much any well-established, utility-focused blockchain. It signals that if you can achieve regulatory clarity, likely as a non-security, if you can demonstrate clear, real-world utility and maintain a robust market structure, well, you're now potentially a viable asset class for the traditional financial system.
Okay, that's a major threshold to cross. Now, this brings us to the profound effects that ETF approval actually has on the underlying asset itself. We kind of synthesized the source material into what we're calling the three pillars of investor impact. The first pillar is the price catalyst. What does that mechanism look like in practice? How does it work?
Oh, it's immediate, and it can be quite aggressive. Once an ETF is approved and launched, the issuer, think BlackRock, Fidelity, whoever, they must acquire the underlying crypto asset, LTC or HBAR in this case, to back the shares they're selling to investors.
They have to buy the actual coins.
They have to. This creates what's known as guaranteed, sustained, passive buying pressure. It's not driven by retail speculation jumping in and out. It's mandated institutional demand built into the product.
And we saw this with Bitcoin, right?
Absolutely.
Yeah.
Just recall the historical example. Even the rumors and then the actual filings for the Bitcoin ETFs drove sharp multi-thousand-dollar rallies. The actual launch then converts literally trillions of dollars of potential interest into active, persistent demand, fueling the price dramatically upward.
Okay, so that's pillar one, price catalyst. The second pillar you mentioned is the liquidity boost. This sounds like where the true scale of institutional money really becomes apparent. Where does this new liquidity actually come from, and why is it so much more significant than the liquidity already in the crypto markets?
Good question. It comes from these massive pools of capital that were previously either legally barred or internally prohibited from participating directly in crypto. We're talking about pension funds managing hundreds of billions, maybe trillions globally, sovereign wealth funds, traditional registered investment advisors, RIAs, who manage vast amounts of client wealth.
So groups that just couldn't touch crypto before.
Pretty much. These funds, they require the regulated wrapper of an ETF to even consider participating. So this influx of capital, when it comes, instantly deepens the market for that asset. It reduces slippage on large trades, it dampens volatility, and it makes the asset generally more resilient against single market events or manipulation attempts.
It's like adding a huge amount of water to a previously shallow pool.
Exactly. It's an order of magnitude increase in market depth, a game changer for stability.
And finally, the third and maybe the most critical pillar long-term, regulatory legitimacy. This one speaks directly to that huge legal hurdle in the U.S. crypto market, the distinction between a commodity and a security.
Absolutely fundamental. When the SEC approves a spot ETF, not futures but spot, holding the actual asset, it provides tacit validation. It implies the underlying asset is not considered an unregistered security under the Howey test.
It's treated more like gold, oil.
Precisely. It's treated as a commodity. And this distinction is literally the difference between long-term survival and potential regulatory obsolescence for a project in the U.S. market. By giving assets like LTC and HBAR this legitimacy, the SEC fundamentally differentiates them from thousands of other projects still stuck in that regulatory gray area, that legal limbo.
It signals to the world, especially to cautious institutions, that these specific assets are considered fit for purpose within the regulated financial landscape.
That's the stamp of approval they're looking for.
So, okay, we've established the mechanism is ready, the assets are ready, the benefits are huge. But the door to the institutional stadium? It's currently locked shut by political theater. Right now we have to address the big complication, the elephant in the room that's currently paralyzing this whole approval process.
Right.
The recurring spectacle of the U.S. government shutdown. When the government basically ceases non-essential operations, what is the exact functional impact on an agency like the SEC, and how does that directly affect the altcoin ETF timeline we've been discussing?
Well, the impact is severe and it's immediate. Agencies like the SEC, they operate under something called a continuing resolution during a shutdown, which means they only fund absolutely essential functions, things necessary to protect life and property, basically.
In reviewing complex new financial products like these novel crypto ETFs, that doesn't count as essential.
Typically, no. It doesn't qualify as an essential function needed to keep the lights on. So the staff responsible for that complex financial product review, the specialized lawyers, the economists, the filing reviewers who pore over these documents, they're largely furloughed, sent home without pay, or operating on severely limited capacity.
So it's not just a slight slowdown like things take an extra week. The clock essentially just stops.
That's a good way to think about it. ETF applications often operate on strict statutory review deadlines, sometimes 45 days, maybe 90 days, depending on the filing type. When the SEC is operating with a skeleton crew, those review periods are effectively paused. They're just deferred, potentially indefinitely, until the government is fully operational again.
It creates a complete bottleneck. Nothing new gets through.
Exactly, and the consequence is systemic. And it's costly. The longer the shutdown lasts, the more it slows down the entire institutional evolution of the crypto market. It delays the entry of all that new capital we just talked about. It reduces innovation opportunities for financial firms who want to launch these products, and it forces the whole crypto industry to basically wait on external political volatility rather than its own internal technological progress.
It sounds like an entirely avoidable friction point.
It absolutely is, and it ultimately costs investors time and opportunity. We've seen historical instances, completely unrelated to crypto, where key regulatory decisions were delayed by months just due to these bureaucratic logjams caused by shutdowns. So the potential for a major delay here is very, very real.
Okay, so given this artificial certainty of regulatory delay, we know it's happening. Even if we don't know for how long, how are the most sophisticated investors, the so-called smart money, approaching this market uncertainty? The source material we looked at suggests a specific market behavior emerging, this buy the fear mindset.
That's right. While the short-term news cycle is understandably focused on the political dysfunction in Washington, which might cause retail investors to panic or maybe divest.
Creating that short-term price volatility we see.
Exactly. But the long-term sophisticated investor, they tend to maintain perspective. They recognize that these delays caused by the shutdown are procedural pauses. They are not fundamental structural roadblocks to the ETF approval itself.
Meaning the underlying case for the ETF hasn't changed.
Precisely. The fundamental regulatory progress made on LTC and HBAR, the arguments for why they should be approved, that still stands. The utility of the assets hasn't suddenly disappeared because Congress can't pass a budget. The reasons for approval remain intact.
Okay, here's where it gets really interesting then. This perspective leads directly to a strategy the sources mentioned, known as temporal arbitrage. Can you break down the mechanics of that? How are smart money traders actually utilizing this political law?
Yeah, temporal arbitrage sounds fancy, but the concept is pretty straightforward in this context. It's basically trying to profit from a temporary misalignment between an asset's price and its likely future regulatory certainty due to a known but time-bound external factor.
And that external factor, in this case, is the government shutdown.
Exactly. The smart money anticipates two key events happening eventually. First, the government will reopen. Shutdowns don't last forever. Second, when it does reopen, those at-the-goal line announcements for the LTC and HBAR ETFs are likely to follow swiftly, maybe very quickly.
Because the work was already done.
Because the work was largely done. And that announcement, when it comes, is expected to lead to a significant price spike, fueled by that institutional entry we discussed.
So, putting it simply, they're using the fear and uncertainty generated by the shutdown, which is currently suppressing the price of LTC and HBR below where they might otherwise be. They're using that as a window to accumulate.
Precisely. They are strategically accumulating these assets now, while they are arguably priced more cheaply due to this temporary political risk premium. They're betting on the inevitable, or what they see as inevitable and potentially dramatic positive catalyst once the SEC is fully back online and operational.
It sounds like a textbook maneuver.
It really is. It's designed to capitalize on political dysfunction by acting decisively during a period of what you could call artificial market compression. If you fundamentally believe the ETFs are coming eventually, then the time when their approval is delayed by these non-fundamental political issues is arguably the best time to position yourself ahead of the curve.
Okay, let's really focus now, zoom in intensely on the two assets creating this historic bottleneck, or rather, waiting at the end of it, Litecoin and Hedera. They represent two wildly different generations, different architectures of crypto assets. Analyzing them side by side, I think, really helps us understand the diversity of what the SEC seems to be currently comfortable approving.
That's a great point. They are very different beasts. Starting with Litecoin, LTC. It's practically ancient in crypto terms, right? Dates back to 2011.
The digital silver to Bitcoin's digital gold. That nickname tells you a lot.
It does, but its longevity, that history, is probably its greatest regulatory asset right now.
How does that longevity actually translate into a regulatory advantage, an advantage that maybe newer tokens simply can't replicate? Why does it feel like it's almost grandfathered in?
Well, the key is really its origin story and its history of distribution. Litecoin was launched via what's generally considered a fair distribution method mined into existence, similar to Bitcoin. This was long before the era of initial coin offerings, or ICOs.
The ICO era, which the SEC frequently labels as unregistered securities offerings.
Exactly, because LTC's launch lacked those characteristics that the SEC often flags, like a centralized fundraising effort, or a clear contractual expectation of profit based primarily on the work of a specific promoter or company. It has largely managed to cement its status over time as a non-security commodity, much like Bitcoin itself.
So it avoids that whole legal quagmire that seems to trap so many tokens launched later, say in the 2017-2020 timeframe.
Generally speaking, yes. That historical clarity is invaluable from a regulatory perspective in the U.S.
So for investors looking at a potential Litecoin ETF, what does it offer them? It's exposure to a proven, secure network designed for faster, cheaper transactions than Bitcoin.
That's the core value proposition. It appeals directly to maybe more risk-averse investors who want exposure to a utility-driven, time-tested blockchain, but without the regulatory headache or uncertainty that might come with newer, less established projects.
It offers stability, simplicity, perhaps?
I think so. It's built on a modified version of Bitcoin's code, which is well understood. It uses a different mining algorithm script, but it's still proof of work. And it processes transactions significantly faster, about 2.5 minutes per block versus Bitcoin's 10. It's reliable. For a traditional fund manager looking to dip their toes into crypto beyond Bitcoin, LTC seems predictable, established, and maybe most importantly, legally de-risked.
Okay, so that's Litecoin, the reliable legacy non-security. Now let's pivot completely to Hedera, HBAR. This is, as you said, a very different animal.
Completely different. Where LTC represents that legacy non-security status achieved through history, HBAR is an enterprise-grade platform. It was built from the ground up specifically to solve corporate pain points, so its positioning for an ETF must rely on a totally different regulatory strategy and justification.
What underpins Hedera's case, then?
Hedera's regulatory standing, or its argument for it, seems built on two really unique factors: its underlying technology and its unique governance model. First, the technology. Hedera doesn't actually use a traditional blockchain.
Right, it uses Hashgraph.
It uses Hashgraph, which is a different type of distributed ledger technology, or DLT. Specifically, it's a form of directed acyclic graph, or DAG-G.
Okay, we probably need to explain Hashgraph simply. How is a DAG fundamentally different from a traditional blockchain like Bitcoin's or Ethereum's? And why might that difference be compelling to institutions and maybe even regulators?
Sure. So think of a traditional blockchain as processing transactions in sequential blocks, one after another, like pages in a ledger. Hashgraph, or DAGs more generally, process transactions concurrently, more like threads weaving together in a web.
So not linear.
Not linear. This allows for potentially much higher throughput, thousands of transactions per second, and extremely fast finality, meaning knowing for sure a transaction is confirmed. It uses a clever gossip about gossip protocol where nodes efficiently share information about the transaction history with each other. For enterprise applications that really need high speed and scale, think micropayments, supply chain tracking, secure logs, Hashgraph can often be technically superior to traditional linear chains.
Okay, so that high technical capability optimized for enterprise needs, that's one layer. But you mentioned a second, perhaps more crucial layer for potential ETF approval. Its governance structure, the Hedera Governing Council.
Yes, this is arguably the key regulatory differentiator for Hedera. The network isn't controlled by anonymous miners or a small foundation. It's governed by a council composed of up to 39 rotating, term-limited, highly reputable global organizations.
And these aren't small names.
No, not at all. We're talking Google Cloud, IBM, Boeing, Dell, Standard Bank, LG, Nomura, a really diverse range of blue-chip corporations and academic institutions.
How does that structure help its case?
Well, this structure is designed very deliberately to satisfy the need for decentralized governance critically. No single entity controls the network or can make unilateral changes while also ensuring enterprise-level stability, strategic direction, and responsible decision-making. It provides accountability that's often missing in more purely decentralized projects.
So institutions looking at Hedera see that massive corporate backing, that recognizable governance structure, and it suggests stability. Serious real-world use cases are being built, and there's significant capital and reputation behind it.
That seems to be the calculation. An ETF approval for HBR wouldn't just be about the token. It would immediately cement Hedera's role, or perceived role, as a kind of corporate-friendly Web3 backbone.
It validates the model.
Correct. It validates the Hashgraph technology itself for regulated finance, signaling that DLT has matured far beyond just peer-to-peer cash systems, that it's ready for massive enterprise tokenization projects, building robust payment rails, handling institutional data management securely. The SEC, by approving an HBAR ETF, would essentially be blessing an institutional-first DLT model.
So the ultimate takeaway then from reviewing these two very different frontrunners, Litecoin and Hedera, is the incredible diversity they represent.
It really is striking.
If a legacy payment non-security like Litecoin and a corporate-focused DAG-G-based utility chain like Hedera both manage to gain ETF approval, it feels like irrefutable proof. Proof that institutional finance is starting to recognize crypto not as just one single thing, but as a diverse functional ecosystem ready for segmented, sophisticated investment strategies.
That's the big picture implication, yes. It moves the whole conversation forward significantly. So, stepping back again, we really must look ahead and analyze the longer-term impact once these political hurdles are eventually cleared. Because the commencement of what we might call the altcoin ETF era, it stands to fundamentally reshape the entire crypto market structure.
How so? What's the mechanism there?
Well, once these mid-cap cryptos, assets like LTC and HBAR, become easily accessible to institutions through regulated ETFs, we should probably prepare for an unprecedented wave of institutional diversification. Money managers will finally have the tools to look beyond just Bitcoin and maybe Ethereum.
And this diversification naturally implies a potentially massive sector rotation within crypto itself, right? For years, crypto has kind of operated under the shadow of Bitcoin maximalism, where BTC dictated almost all the capital flows, the market narrative.
Absolutely. Bitcoin has been the tide that lifts or sinks all boats. But institutional access to diverse altcoins through regulated vehicles provides viable, legitimate alternatives to holding only BTC. Capital will start to chase utility or growth potential or different risk profiles wherever they are most efficiently generated across the entire spectrum of digital assets.
So money could flow based more on the merits of individual projects, not just the overall crypto market sentiment led by Bitcoin.
That's the theory. It allows for more sophisticated portfolio construction within crypto, and this leads to a profound shift in narrative as well. Utility-focused altcoins, those genuinely built for payments or smart contracts or specific enterprise adoption cases, they will permanently transition in public perception.
How do you mean transition?
They move from being dismissed by traditional finance as purely speculative side bets or, science projects to becoming legitimate regulated financial assets with demonstrable use cases. And that legitimization process, once it's achieved through an SEC-approved ETF, it's virtually irreversible. It changes how the asset is fundamentally perceived and valued.
Okay, that makes sense. We also need to analyze the potential for these dedicated capital flows, the money coming specifically into crypto ETFs, to maybe decouple crypto price action from traditional risk assets, especially tech stocks like the NASDAQ. Right now, crypto often behaves like a sort of high beta tech play.
It often does, yeah. They trade in correlation quite a bit. But what happens when dedicated crypto ETFs start attracting potentially trillions of dollars in assets under management over time?
What's fascinating here is
What's fascinating here is the potential for genuine autonomy in price movement. If the source of the money flowing into these altcoin ETFs is unique, let's say it's coming heavily from pension funds or insurance companies following specific long-term diversification mandates that are quite different from typical equity investment strategies.
mandates that aren't just chasing quarterly returns like a hedge fund might.
Exactly. Then that capital, that huge pool of dedicated mandated capital, it might react very differently to external economic pressures, like interest rate changes or inflation reports, than the NASDAQ Q or the S&P 500 would. This influx could create its own gravitational pull, its own market dynamics.
Leading to potentially a much greater degree of independence in crypto price discovery over the long term. Less correlation with stocks.
That's the long-term potential, yes.
Yeah.
A true diversification benefit, not just another risk-on asset.
Now, to really grasp the scale of this potential transformation, we don't have to rely purely on speculation. We can look at historical precedents, right? History offers some pretty clear analogous examples of what happens when institutional-grade infrastructure, like an ETF, is applied to a previously hard-to-access asset class.
Absolutely. We have some very relevant comparisons. The most immediate and perhaps most direct reference point is the launch of the Bitcoin spot ETFs in early 2024.
Right, that just happened.
The data there is undeniable. The approval and the subsequent launch triggered massive, record-breaking daily inflows into these new ETF vehicles. Billions poured in day after day.
And that was passive demand.
Largely passive demand from the ETFs needing to acquire Bitcoin to back their shares. This was the primary catalyst, most analysts agree, for Bitcoin's rapid rally past $70,000 within just a matter of weeks. It proved conclusively that the latent institutional demand was absolutely enormous, and the ETF mechanism was the necessary key to finally unlock it.
Okay, so Bitcoin ETFs showed the immediate power. But maybe the more insightful longer-term comparison is the gold ETF parallel, going back to 2004.
Yes, the GLD ETF launch. Before that happened, physical gold, while valued, was actually quite difficult to acquire, store securely, and manage efficiently for both average investors and large institutions. It was somewhat of a niche asset in portfolios.
You couldn't just click a button and buy gold exposure easily.
Not like you can now. But once that institutionalization occurred through the ETF structure, it fundamentally changed gold's market trajectory for the next decade. Gold prices, which had been hovering around $400 an ounce for a while, began a steady climb. They went to over $1,800 an ounce within about 10 years.
Wow, more than quadrupled.
And that surge wasn't just a short-term pop. It was sustained by passive, continuous institutional demand flowing through those ETFs. So if approved crypto assets like Litecoin and Hedera managed to achieve even a fraction of that kind of institutional saturation via their own ETFs, well, their long-term value trajectory could potentially follow a similar explosive, demand-driven path.
It sets a powerful precedent for what institutional access can do. And there's one final mechanism mentioned in the sources that will likely contribute significantly to market restructuring, especially for some older assets. The process of grayscale trust conversions.
Ah, yes, grayscale. This is important too. When Grayscale is eventually permitted, as they were, for their Bitcoin trust to convert their other existing closed-end trusts, like the ones for Ethereum Classic, ETC, or Litecoin, LTC, into proper spot ETFs, it essentially unleashes previously trapped liquidity.
How does that work? What does trapped mean here?
Well, these Grayscale trusts often traded at significant discounts, sometimes massive discounts, to the actual value of the crypto they held, their net asset value or NAV. This was because shares couldn't be easily created or redeemed, locking capital in. Converting to an ETF allows for arbitrage mechanisms that typically force the share price to track the NAV much more closely.
So the discount disappears.
The discount generally disappears or shrinks dramatically. This unlocks significant shareholder value for those holding the trust shares. But more broadly, it injects fresh institutional interest and capital into these assets, assets that might have been somewhat forgotten or overlooked while they were stuck in that less efficient trust structure. It essentially renews the market's attention on them.
So it's another powerful catalyst, ensuring that once the dam breaks on ETF approvals, the flow of institutional capital is likely to be sustained and come from multiple directions: new ETFs, converted trusts.
Exactly. It's multifaceted. So whether we look at the immediate explosive success of the Bitcoin ETFs or the longer-term historical parallel of gold's institutionalization or the specific conversion mechanics for existing trusts like Grayscale's, all the signs really point towards an inevitable financial evolution for select crypto assets.
The technical readiness is there. The institutional demand seems robust and waiting. The only true obstacle right now appears to be procedural, caused entirely by this temporary political friction. #outro. Okay, let's synthesize the critical knowledge we've unpacked today in this deep dive. It really confirms two foundational truths for you, the listener, to take away. First, the regulatory comfort level on the merits of these specific assets seems high. Key altcoin ETFs for diverse assets like Litecoin and Hedera are technically at the goal line.
Yeah, that hurdle seems cleared, fundamentally. It proves regulatory barriers can be overcome for different types of crypto assets beyond Bitcoin.
And second, the current biggest impediment, the main thing holding back the official start of this potential new era, it's external. It is purely political delay stemming from the government shutdown.
Exactly. The market's kind of in a holding pattern right now. But importantly, it's a pattern that strategic investors appear to be exploiting, accumulating these assets before the almost guaranteed positive announcements eventually hit once the government reopens.
So this moment, therefore, really defines a potential shift. A shift from early crypto adoption, which was maybe more speculative, into a phase of diversified, regulated institutional allocation.
A maturation of the market, potentially.
Which leaves us with our final provocative thought for you to ponder. Given the apparent success of legacy assets like LTC and these corporate-backed chains like HBAR in clearing the necessary regulatory hurdles for an ETF, how quickly will the market, the institutions, start pressuring the SEC to provide similar, formal clarity on other utility giants, projects with massive market relevance already?
You mean names like Chainlink, Solana, Cardano?
Exactly, those kinds of established players. Will the dam breaking for LTC and HBAR create immediate pressure for the next wave?
It seems logical that institutional appetite for diversification, once whetted, probably won't stop at just two altcoins. Once the floodgates open, the pressure to include the entire viable utility spectrum could become immense quite quickly.
Absolutely. Something to watch very closely.
Right.
Now, if you found this deep dive helpful, And you want to stay ahead of how politics and regulation are shaping what could be the next crypto bull run. Make sure to like this video, subscribe to the Crypto Robot channel, and definitely hit that notification bell.
Yeah, seriously, all that engagement, subscribing, commenting, liking it really does help support the channel. It boosts our visibility in the algorithm. And honestly, it just lets us keep creating this kind of in-depth crypto content for you.
It helps us keep bringing you the alpha that, let's be honest, Wall Street probably doesn't want you to know about just yet. We really appreciate you joining us for the deep dive today.
Thanks, everyone.
We'll catch you next time.